Well, markets are flat as investors look ahead to a busy week of economic data and corporate earnings. Momentum slowing after a record-breaking week for markets last week, led, of course, by Nvidia earnings. Our next guest thinks it may be time to lighten up on the sector. To break this all down for us, we have Gary Schlossberg, Wells Fargo Investment Institute Global Market Strategy here. Good to talk to you today. Let's kick things off with economic data this week because, yes, we've got durable orders, we've got wholesale inventories, consumer spending, but it feels like so much of the market direction is going to hinge on what we get in that PCE data. What are you expecting?
Yes. Well, we're expecting a slight uptick in the monthly number that could drive the year-over-year number up just a bit, just adding to the concern that that momentum behind disinflation that we've seen over the past 12 to 18 months is winding down. We saw that with the CPI, and the concern is that Thursday's PCE data could reinforce that view.
And you've highlighted specific concern here as it relates to the inflation data, that there is a big gap between the year-on-year comparisons of core CPI, core PCE. Why do we see such a wide divide there?
A lot of it has to do with the way the indexes are put together, the way housing costs are measured, and the like. The way medical care costs are treated, similar in the PCE deflator to the wholesale price number. The two have diverged a bit this year. The PCE deflator generally running below that CPI number. And of course, the PCE deflator is important because that's the favored inflation measure by the Federal Reserve. But the direction, the trend that we're seeing in each, the trajectory of each, seems to be flattening out a bit. And that's of concern to the market, regardless of the inflation measure you look at.
Gary, we are, of course, coming off of what was a really incredible week fueled by Nvidia's earnings. At least for the week being, it did feel like, given Nvidia's numbers in the latest numbers in the quarter, that a lot of the gains that we have seen in the stock, investors could justify. How concerned are you about the froth that's building within the AI space? Or is it froth? Is it justified, backed up by the numbers?
Well, the market may be getting ahead of itself. Clearly, there are tremendous opportunities in the AI area. But as we've seen with technology in the past, we have had the market run ahead and then go into something of a correction. And the timing and the extent of that correction could depend on what the Federal Reserve does, what the economy does. And for that reason, we're more guarded on technology. We've pulled back a bit. We're neutral toward that sector of the market. We're more favorable toward energy, healthcare, industrials, and materials and the like for a variety of reasons. But our big concern is that tech has benefited to some extent by very easy financial conditions, which are becoming less so and could continue to tighten up if, in fact, the view on Fed policy turns a bit less sanguine over the next several months.
Gary, you mentioned energy is one of the positions or one of the sectors you're more favorable in. What do you like specifically there?
Well, we think fundamentally the market is tight. Our real asset strategist, John LaForge, feels that we're in the beginning or early stages of a commodity super cycle, which extends not only to energy, but also to other commodities. And that fundamental tightness means that energy prices, we think, are biased to the upside, both near term and out over the longer term, just given certain supply constraints, greater OPEC plus discipline. And for that reason, we view that sector more favorably. Of course, a lot depends on the extent of any future global economic slowdown. But at the moment, we think the supply-demand balance favors that sector of the market.
Gary, you are, of course, looking globally, not just in the U.S. We did get that annual letter out from Warren Buffett over the weekend, really sort of reinforcing where he stands on at least Japanese firms, the trading firms specifically. We saw the Nikkei hit a record last week. What's your exposure like to that market right now? And how much longer do you think this can continue in terms of the upside?
Well, we tend to be exposed more in terms of broad regions, developed markets, emerging markets. We don't typically focus on a single market, with the exception, of course, of the US. As far as Japan goes, though, we do look at the economy. The economy is struggling a bit, but the export sector is benefiting from a relatively cheap yen. Certainly, Japan is sensitive to conditions overseas. But while the Bank of Japan maintains a very accommodative policy stance, that provides an important tailwind, we think, for the Japanese market, contributing to the rally that we've seen, importantly, to the rally that we've seen over the past year.
It's been incredible to see that run up there. Gary Schlossberg, Wells Fargo Investment Institute Global Market Strategist. Good to talk to you on this Monday. Appreciate the time.
Thank you.